Today, we are honored to have Encik Amiruddin bin Abdul Hamid, the head of investment, Muamalat Invest, Sdn Bhd, and Mr. Hao Chi Hong, the fund manager of Phillip Capital Management, Sdn Bhd, as our panelists today. Allow me to introduce our speaker. Our first speaker is Encik Amiruddin bin Abdul Hamid. He's a distinguished professional with an illustrious career spanning over 2 decades in the investment industry, took the helm as the head of investment at Muamalat Invest Sdn Bhd in October 2021. Before joining MISB, he was attached to the investment management firms with different spectrums, cultural ethos, and procedural flow. His professional journey began at PNB in 2002, a highly reputable government-linked investment company. His career took a significant turn in 2008 when he became part of Amundi Asset Management, the largest fund manager in Europe, where he was among the pioneering members of the KL office. Amiruddin's career path expanded significantly with his association with 2 bank-backed fund managers, Public Mutual Berhad in 2014 and RHB Asset Management in 2016. He then made a significant stride in his career by joining Meiteor by Gex MD, a digital investment management company powered by sophisticated algorithms started by a joint venture between Japan's first robo-advisor and a leading technology company in Malaysia. Mr. Amiruddin's unique background as a fund manager distinguishes him in the field. Not only was he the first digital fund manager in Malaysia after joining Meiteor, but he also played a pivotal role in establishing the developed market investment desk at Public Mutual and the China Asia product at RHB Asset Management. Furthermore, he's the first fund manager in Malaysia to manage portfolios with exposure in extremely volatile emerging markets, including Brazil, Russia, Argentina, South Africa, India, and Turkey. Our second speaker is Mr. Hao Chi Hong. He's the fund manager of Phillip Capital Management Sdn Bhd. He joined PCM in November 2020 as an analyst and was promoted to fund manager after a year after joining the firm. Before joining PCM, he was an equity analyst at JFX Securities. During his tenure, he covered sectors such as tech, gloves, property, and construction. Mr. Hao currently holds a CMSRL license. He also graduated from University Utara, Malaysia with a Bachelor of International Business. Let's start with the first question. Perhaps we can start with a more general question to Encik Amiruddin. We all know that the global markets have performed relatively well year to date, and that's despite the interest rate, specifically the US, remain high for longer and investors being uncertain about the future direction of interest rate. What factors do you believe are driving this outperformance? And do you expect this positive trend to continue in the second half of this year?
Okay, thank you, Kim. Thank you for introduction of myself. Okay, first, let me start. Okay, when you look at US market today, definitely US market done very well, as Kim highlight before. So Nasdaq actually went up around 18%. Then you have S&P 500 went up by 15%. But when you look at Dow Jones, the rate of appreciation actually much milder, only at 8%. And the small cap company actually come up still negative return year to date. So what we can see today is Mr. Cho highlight, interest rate in US still very much higher. Basically because Federal Reserve don't want to make any move. Basically when they see that, okay, the inflation data and the wage growth in US still very much on the high side. So if you look specifically at the performance of index year to date, is mainly driven by growth. Company that deliver growth. We mean PE rating on the growth company. You can see that one of the biggest company that driving the index is NVIDIA. Nobody talked about NVIDIA 3 or 4 years ago. 3 4 years, people still focus on Facebook, Google, Alphabet, and Tesla. So what you see is analysts have overestimated how explosive is the growth in AI. NVIDIA EPS, earning per share, you look at 1 year ago is only 11 cents per quarter. So today is 61% quarter. So it's about more than almost 6 times higher than it was 1 year ago. So it's so easy for analysts to underestimate, and that's why the reason they have to upgrade And when they agree, it creates a positive tone into the market and people start chasing market. And Nvidia went up by 150%, right, year to date. So it driven about 1/3 of the outperformance of the performance of S&P 500. That's why I think the market will continue to sustain. If you look forward, market still continue to be what we call quite pessimism on the growth of AI stock. You look, their forecast for Nvidia for next year only 75 cents. Can you imagine? This quarter is 61 cents. Last quarter is only 51 cents. For the whole year, you expect Nvidia to go up by another 10 cents. I think it continue to be the same old story scenario. I think analysts continue to be chasing the EPS forecast for AI company stock. This will driving share price further lah. That's why I think I'm quite positive on the market outlook for the second half of this year. The only thing I'm more concerned is US election lah. US election coming at the end of the year. But basically, I think this year election will be less explosive compared to the one that they have in 2000. I think in 2020 lah. I think this year people quite confident that Trump will win the election. So some expectation have been met. So in the run up to the election, the market will be volatile. It tend to go down because the presidential candidate tend to announce, that policy they are more favorable to US and doesn't benefit anyone else. Especially China will be any policy on China will be negative to the market lah. But you look at historical, if you look at in the past, right, every time there's election, stock market tend to trending downward. But once the election result announced, they start to rally once again. So I'm quite positive on the market outlook lah for the second half of this year.
Okay, thank you, Encik Amiruddin, for the comprehensive answer. So he explained on the outperformance of the market this year is mainly driven by the AI excitement, is driven by the valuation as well as earnings revision. So how do you think that the market will perform better in the second half of this year?
Yeah, I think market generally will perform better in the late of the year lah. But I don't think the market will go up as smooth as first half. I think maybe like close to I'm reading said just now, the election may create some market impact, maybe a short correction upon approaching the election or after the president being elected. So, but actually, what I'm so confident, what I'm a bit optimistic about the second half is actually look at because in the first half or since last year, actually, all majority of the index performance driven by the top 7 companies in the US, right? So this actually backed by the strong fundamental because if you look closely at some analysts forecast of the earnings actually bottom in third quarter 2022 and quarter and year keep going up sequentially until I think second quarter 2024. So moving forward in the next 4 quarters, the earnings of the US company will continue to be growth, and based on some forecast by analysts, those growth will be spread to other companies. It means that the companies X Max 7. I think this is quite reasonable because you look at I think the second half of the next 12 months, the backdrop is a rate cut, right? So rate cut maybe tend to benefit some companies that suffer suffer because of the high interest rate. So market generally consensus are looking at a spread, a whole recovery of the earning per share instead of Max 7. So in general, I think second half will be quite good, but I don't think it will be as smooth as the first half. This is my take.
Okay, thank you, Mr. Hao. So Mr. Hao basically explained on the earnings has already bottomed a few quarters back, and now it's poised for earnings growth. And coupled with the backdrop of rate cut expectation this year, some of the companies, especially mid-small cap companies, will eventually catch up. Since we are on the topic of rate cut, Encik Amiruddin, the ECB, the European Central Bank, has lowered their interest rate by 25 basis points during the meeting this month. Do you think the US Fed will follow suit? Early this year, there was talk of 7 rate cuts in the US, but now the expectation has shifted to just 1 to 2 rate cuts beginning in September. And what are the chances that we may end up not having any rate cut this year?
Okay, thank you, Kim. That's a good question. To be honest, when I look at Eurozone, actually ECB, European Central Bank, actually announced a cut of 25%. It's point I'm quite surprised. For example, because you look at the pattern, you ignore the number, you look at the pattern of the economic variable such as interest rate cut, inflation, you know that the inflation start to hit the market way in 2021, right? So then they start to increase it. They start to increase interest rate in 2022. Both US and Europe, and US start first, I think around March. Then Europe start later. Then inflation go all the way up. Then inflation peak in US around June last year, 2023. Inflation peak in Europe was 4 months later. I think it's September or October. I mean, if you look at the pattern, right, everything Europe tend to lag US in terms of economic numbers or or inflation in terms of their monetary policy direction. Only for this one round, actually, when they cut interest rate, Europe ECB actually cut interest rate much earlier. Even though the two countries actually so much alike, they are so identical in so many ways. The economic pattern is the same. Last time the economic number tend to be stronger than expected. Both countries are the same. Both region, for example, I assume Europe also is the same. Then last year you can see they actually resist a rate cut because of scare of inflation. The thing is too early to say, and the problem is the same. Wage growth is too high in both countries. Suddenly, Europe actually cut interest rate. But you look at historical pattern, right? US and Europe actually the way they manage they run monetary policy is way differently. When US cut interest rate, they tend to do it in a series. You mean if they cut interest rate this month, then this month, next month you can expect there's another cut or next month. You mean subsequent there will be a series. You mean they'll cut it in a bundle. But Europe, you historically, there's quite a number of questions they actually cut interest rate, and for the next 3 to 6 months they are doing nothing. So this is the case. That's why I'm thinking, yeah, if you look at the inflation, both countries, the inflation still way above their own target, the 2% targets. So both countries have no reason to cut interest rate for time being. What ECB do is just one off. It's just something that have been done in the past because they already promised the market they want to cut interest rate. Nothing else. There's no economic reason behind that because they only promise. What I think is it's more likely that Europe will stop at one cut, the cut they have been done rather than US follow Euro to cut rate. I think there's 80% chances that US will not cut interest rate because I don't think there's any reason for them to cut rate because you look at inflation number basically. Inflation number have been going down and already stopped by February this year and now have been around that level for quite a few months, I think 3 or 4 months already. So there's no reason for them to cut. The only reason for them to cut because their economic numbers now going below than market expectation. That's something they need to watch out. But I think there's still 80% chances to cut. Other than slowing economic growth, the rest look status quo for them. There's no reason for US to follow Europe to cut it. I more think that Europe will stop there at 25% point cut that they already announced this month and no more cut from Europe for this year.
Okay, thank you, Amiruddin. So he mentioned that basically the chances of rate cut in the US this year is quite minor. It's only 80%. What about you? What do you think, How?
Because you look at, thank you, Amiruddin. Okay, first you look at the Fed futures forecast. They're looking at the first cut in September, right? But this figure could be very volatile. It could be changes over time. I think there's still a chance for US to cut rate in this year, maybe end of the year, but lately December or October in September. Because I think there's political pressure for Fed because even you look at Biden or Trump, both they are in same camp for rate cuts. They are not looking at the rate high because they want to please people to get more voting, right? So I think by hook by crook, there's a maybe a cut, just a signal to a market we are in a new cycle, the new rate cut cycle. But the magnitude may not be so big. Maybe just a 25, maybe just a next year 50, just a mild rate cut. But even you cut 25 to 75, actually the interest rate is still way higher than the pre-COVID levels. It's above 4.5, even if you reduce 75 basis points. But for ECB, I think they had the rate cut recently, like in the last meeting. I think mainly this time the economy for Europe and US may not be moved in the same way. I think one of the big difference between two major economies is this the labor market. And actually in US the labor market is quite tight, so they don't have the worry to cut the rate. But if you look at ECB, they don't have the problem in their labor market, so they are more comfortable in rate cut. And besides, I think one of the reasons for ECB rate cut is also election. You look at actually France had their election, right? So I think to a certain extent, rate cut is not a pure economical decision. Mainly, they need to look at your country's stability. You need to hook up with your the policymaker, right? So I think various of reasons are, but the overall direction I think is a rate cut. May not be too steep, but the rate cut cycle is started. That's my take.
Okay, so we see some different views here. How argue that there could be a rate cut, probably because of the political pressure ahead of the election. So he also explained on the labor market dynamics in Europe and US. They are totally different, and that also prompted different central bank actions. Moving on to Asia, Encik Amiruddin, valuations appear lower compared to their developed market counterparts. As of 31st May 2024, the Asia Pac Japan Index trades at a P/E ratio of 13.3 times, a 27% discount to the MSCI World, which trades at 18.3 times. What factors have contributed to these differences, to this gap in valuation? And do you think Asian valuations will eventually catch up?
Okay, if you look at, you pointed correctly that actually you look at the number, basically MSCI developed world, obviously more expensive than Asia Pacific, but there's two big variable here. If you look at actually MSCI global, actually they have more component of technology there, right? So because the US company like Nvidia, Microsoft, everything. So this company, you look at the whole sector as a whole, this sector actually trading at PE of 40 times. Obviously, they actually bring up valuation for the whole market lah. This significantly higher compared to any other sector across that index. And if you look at Asia Pacific and Japan, of course, China is a big country. And China, as you are well aware, I think is one of the more cheapest market in entire world today for a reason lah. They trade already at PE 10 times. Obviously, China valuation actually drag down the whole valuation of Asia Pacific, and developed market actually doing well. If you look at perspective of valuation, if you look at perspective of performance, you look through. When I first cover, I was in the market for quite some time, you know that developed market actually starting, if I'm not mistaken, in 2017 lah. If you strip out COVID-19 crisis, which is one of basically US market already really since 2017 lah. They take over from at the time was Asian region lah, and China market had not done anything fantastic since 2008 lah. So you can see this what are driving in US actually quite fundamental. The driving by tech company, Microsoft, at the time Netflix, even you see company like Alphabet actually announced a strong growth number, right? That's why they are rallying, because earning is growing. Then you look at company like Nvidia, look at company Microsoft actually they start rallying since they move into from selling software to a subscription-based software, basically Microsoft 365. And since that, they announced quite a number of things. So from selling base to rental base, they actually earning growth still pick up. And you can see the explosive growth earning is starting in 2017 lah. So there's a big reason for US market to late, and there's a big thing is fundamentally driven lah, to be honest. And you look at Asia Pacific also, is fundamentally driven. China from went from bad to worse lah. The economy has been slowing down since 2014, mainly because of demographic. Then property sector, the collapse of property sector actually add to the more worse into China sector. But you look at the other market relatively, every Taiwan still depend on Taiwan matter. And you look at it now, I think if you look at that perspective, I think premium in MSC world is justifiable. If you look, the premium is only roughly 20% because they have more component of technology stock. That's why I think for them to continue to outperform MSCI world, I think it's acceptable. That's why I think going forward, I'm not going to surprise when US market continue to do well.
Okay, so basically that's the reason that basically different indexes have different components, and MSCI World has bigger portion in tech. How? So which market or region do you believe has the most potential? Do you think Japan, China, India, Korea, or others could stand out this year?
I quite agree with Encik Amiruddin. I think US market will continue to outperform. Actually, okay, I think this AI rally in the US market, you have a lot of AI companies, right? You get Microsoft, Nvidia, you have Broadcom, whatever you can name it. So I think this also is a lesson to global investor that the most profitable, the best AI stock actually in the US. So if you haven't allocated any stock, any allocation into a US market, if you're Asia-based investor, you will look forward to increase your holding in the US market because of its so vibrant in the stock market, in the US market, a lot of things you can buy, and a lot of underdogs still yet to be discovered because of the AI, right? The first wave is infrastructure. It could be another thing. It could be software is coming, Adobe or whatever, Salesforce. So I think the valuation premium will continue to be there and even be widened in the future. Because you look at Asia, you actually in Taiwan, Korea, maybe some Malaysia stock, you hardly find any companies have a lot of AI beneficiaries, right? So I think this will be the US market premium will continue to outshine. But I do not deny that other market may have the chance to rebound or enter the structural growth story, for example, like India, Indonesia. China may have some chances, but I think a bit tough. They are not the direct beneficiary of AI. But I think, yeah, these are the market I think are quite positive and my view on the valuation gap.
Okay, thank you, Hao. So, Amiruddin, which market do you think has the most potential? Is it India or China or even US?
I agree with Ching Kun in one part. Basically, he said that if you want to buy AI stock, US market is the only place to buy AI stock. There's quite a number of AI stock in, but not significant enough or large enough to driven on market. I think India really got more legs to go because you look economy because India basically driven by economic growth. I think there's a lot more room for India economy to grow further. You look India GDP per capita now around 2,400 US dollar, right? Still lower compared to Philippines, still lower compared to Indonesia, and much lower compared to Malaysia and China. There's so much room to grow there. So you look at valuation is not overly expensive. If you look China, those days in 2008 is much more expensive than India today lah. Then when I look another market that I want to highlight is I think China maybe they got some opportunity lah because you look China market is very cheap and China market has been forced to innovate. That's one thing that I like lah because the trade war between US and China have forced the US have sanctioned quite a number of companies from selling chip to China. You can see China now start developing their own chip. I think SMIC and Huawei had done a great job lah. I think if you want to find another company that could compete globally, should come from China because they were forced to innovate, right? Suddenly, because they are big, they have a sizable market, in the future they might as well sell cheap to another country as well. So the company that can become another Nvidia could be a Chinese company lah. So that's my point of view. I think for the rest of country, I think there's not something we call, if you look at Japan, you see the same old companies 10 years ago and today, same Taiwan and Korea. So that's why I think, as I pointed, US, India, because of what I call capacity growth still there, and I think China for potential of innovation lah, because they have been successful in innovating. So there could be a sector or stock to look out lah for the next 3 or 5 years.
All right, thank you, Encik Amiruddin. Since we are on this topic on AI, things like thematic investing, we all know that the tech sectors, the AI stocks have done well this year, and they've been driving the market activity this year. And while in Malaysia, data center related plays, the renewable energy team have generated significant excitement as well. Do you think these teams will be sustainable, Encik Amiruddin? And are there any other teams that we might have overlooked that you anticipated will gain interest?
Okay, you asked me quite two questions is AI. I think if you look at I think you mentioned two sector, immersion, AI or DC lah. I think AI is a sustainable play. I think AI is still quite in a baby stage for me lah. Because you see, right, one of the biggest AI that come up into market is ChatGPT. 3 years ago, I think people know your name, Ching Hung name, and my name more than ChatGPT. Now everybody know about ChatGPT. ChatGPT for me is a game changer lah, because actually this technology can be reused to many sector and innovate so many sector. So AI, then you have new chip is coming up into the market much faster, 3 nanometer, and I think it's revolutionary, and definitely AI sector something, I think something that can goes on for the next few years, 3, 5, or even 10 years. But on DC play in Malaysia, I think is over. I think is, for my point of in my own view, is chiefly overhyped lah. Basically, if you look today, it's more about news driven. For example, if you look DC, there's so many company that related to DC have been in play. For example, this maker, you have Notion Bitech, JCY, really, even though the number not yet show, and construction company. For example, the one that won most of the DC contracts only Suncon, Gamuda only won one. And you have to remember, construction contract, when they won this DC sector, could last only 2 or 3 years. After that, there might be no more DC sector. So it's not something that's sustainable. You cannot win, like you cannot win that kind of contract every year in, year out, right? Then you have some property developer, for example, Crescendo, saying they've been selling land to DC company. That's not sustainable. One you sell, there's nothing left lah. Basically, there's two sector. I think the two company that I think quite sustainable in terms of sign property, basically because they actually will earn rental income from center, even though their share price might run ahead of the fundamental, but in the end, it's quite sustainable lah, because basically you own the center, you collect rental. Tenaga is make more sense, even though the impact slightly more smaller compared to sign property, because you get to sell more electricity to the city. The rest, I think, is you have to pick and choose between stock. There might be a hype there lah. I think then back to another question you asked, which I think the team that actually people not yet realize. I think the recent announcement of 2H actually is got a lot of substance there lah. Because previously I used to cover quite a number of market. I used to talk with a stockbroker from Thai and Philippines lah. There's one stockbroker from Philippines telling me he just bought a condo, quite a huge condo, 60 square meter in Philippines. It's considered big. In Malaysia, we got a lot of condo that's huge. The 2H actually removed the annual income. The threshold for buying property is much lower. If they now, unlike the previous 2H, they now divided into 3 categories: platinum, gold, and silver. For the silver, the package under silver, you can buy property as low as 600,000, right? that will be key driver into property sector. You can see over the time, you can see quite a number of people start to migrating from developed market to Malaysian market, right? You can see now you go around a new era, like I'm staying in Setiawasa, I never seen so many foreigner in Setiawasa. Last time you never see any foreigner in Setiawasa. Now my condo about 50% are foreigner. So I think MM2H is something that is unappreciated catalyst that now have been announced recently by Malaysian government.
All right, thank you, Encik Amiruddin. So basically, looks like the AI team, the DC related teams are sustainable, but of course, within the sectors, the job of a fund manager is to identify winner in the sector and invest in it. And of course, he also mentioned that the MM2H team could be valid, right? Migration, people could be migrating from the economies to developing countries like Malaysia, things like that. So, Mr. How, do you think the DC play, the AI play are sustainable? And what are the teams that you think will probably catch up eventually?
Maybe we start the first question. I think I think I quite agree with Amiruddin, just the beginning only. Because recently I attended a conference, so there was Sky, the chip design CEO. He mentioned the first wave of semicon started by this CPU, Intel, right? Second wave started with Apple, Qualcomm, and this kind of mobility companies. They mobilize the chip, right? So his comment is the third wave begin with the AI. I believe that we are just the beginning, and AI has proven its power. Like you say, ChatGPT, even they can create some images and videos in a shocking way. So I think a lot of upside and a lot of potential in the sector. I think this could be a decade rally for AI. So we talk about the next theme. I think since last year, I was looking at software could outperform hardware in after the semicon rally, but actually it yet to happen. But you see, Nvidia, Broadcom, and some semiconductor companies still had quite a good rally in year to date. And I think the moment when the software companies start to pick up is when they start to show their capability of monetize the AI. So I think the AI wave will extend to some software. Like actually, if you look at the latest quarter earnings call by this Adobe, they already utilize their AI model in their a few of their flagship application like Photoshop, like Adobe Acrobat, etc. So I think the moment that the money will shift from semicon to software is matter of time. I don't have a crystal ball. I don't know when it will happen, but I strongly believe it will happen in somewhere maybe 2025 or begin of 2026. I think you will see some software company start to outperform again. Because if I think 2 days ago, I looked at a chart compiled by Goldman Sachs. The weightage on the semiconductor by hedge fund is they get low. I think very low. People so underweight software company. People just shift the money to semiconductor. But you have to understand, all these hyperscalers they are buying cheap, so they are developing their own models, right? They are creating something that can add value to people. Which means it's a software, right? So I think at some point this sector will outperform. Maybe we have another ChatGPT moment in software company in the US. So once again, US market is so dynamic, is so resilient. You have a lot of things ready to outperform, to outshine in the world. Yeah, that's my take.
So, how what are the teams that you think could catch up eventually? Do you think any, like, just how Amiruddin mentioned about MM2H, that's about migration, things like that could actually boost up property demand and probably tourism, things like that. But in Malaysia, do you see any potential teams that have yet to shine, have yet to be discovered by investors?
I have one in my mind, but not in Malaysia. Is a drone economy. Yeah, because if you look at China, actually there are some companies they involving in producing drone or have this drone technology. But actually, in fact, this thing also closely watched by US because it's a technology that you can link to defense. So it's a team I think not yet exposed, but there's a potential to have their own rally lah. But for Malaysia, I think I quite agree with Aminuddin that Tenaga could be a structural could start the structural growth story moving forward because as you mentioned AI that requires a lot of electricity, right? So I think some research houses pointed out that 10 years later, AI will, I think, account for 10 or 20% of global electricity usage. So, Tenaga is I think Tenaga also work up with the government to set up Malaysia as a exchange of renewable electricity. So, as Malaysia have a lot of data center in Johor side, so I think these hyperscalers, they also demand for clean energy, the sustainable way to power their like data centers. So I think the Tenaga and some power generation could start their structural growth after years of depressed, I believe, power generation.
Yep, correct. I think some of the utility players in Malaysia have been underappreciated back then because of the ESG issues, things like that. But things have improved since then. So since we are on Malaysia, Amiruddin, with KLCI up by about 10% year to date, and the mid cap and small cap indexes performing even better, do you think it's still a good time to invest in Malaysia? Why or why not?
Okay, I think I think still a good time to invest in Malaysia. If you look at it, right, stock market cycle usually is either 8, 10 or 12 year cycle. The last time we have a big market correction was 2008 and market all the way really until 2020 lah, all because the COVID-19 lah. But Malaysian market per se, actually Malaysian market already peaked somewhere around 2015 because the corporate earning peak. But if you look at it, right, during this cycle, this current cycle started somewhere around late 2015, but actually the rally actually halted by the war in Russia and Ukraine that caused a lot of inflationary pressure in the market. So market went back down again. Then last year, Malaysian market doing almost nothing, right? Almost nothing. You get it. Malaysian market just start to rally again this year, and really, of course, very huge. It's about 10%. But you look at it, the market cycle doesn't usually last 1, 2, or 3 years. As I said, it lasts 8, 10, or 20 years. If you look at in terms of corporate earning, right? Only this quarter you can see some positive corporate earning in Malaysia, both large cap small is the first quarter only, right? So I think there's more to come in couple next quarter. I think economic outlook is improving. Our economy is getting better. Unlike last year, our economy fell below expectation. There's a reason for our stock market to not perform. And secondly, if you look last year and this year, last year, the market that performed is a service industry. You look, that's the only time we see service actually outperform manufacturing. You look, global trade was shrinking last year. And last year, our export growth number are negative. This the first year we start to turning around. I think it start to normalize. I think this really will be sustainable. And you look further on valuation perspective lah. Malaysia typically trading something like 16 times PE. Now our PE, if you look based on different valuation metric, it's only around 14 to 15 times. There's a lot more room to grow. Even you don't consider any PE rating, there's still a lot more upside to Malaysian market lah. I think Malaysian market is just a beginning stage of rally. Even there will be some concession maybe in next few months, but I think general trend is Malaysia is still starting a new, just at the beginning of the rally cycle lah. That's why I think it's still a right time to buy into the stock market.
All right, sounds very positive. Looks like the valuation, the earnings, even the economic fundamentals remain solid. What do you think on the Malaysia market?
Yeah, I think I'm the same camp with Amiruddin, Haji Amiruddin, because if you look at why KLCL has done so well this year, actually not driven by foreigners, driven by local fund. So actually, I recently also talked with some industry people, maybe some they are from Singapore, even one from UK. So I've talked to them, they don't really too much to understand about why Malaysian market actually doing quite well this year. They also quite surprised. Even I also talked to some local investor, quite very experienced fund manager. They also miss out the rally. They have been investing overseas. They couldn't figure out why Malaysian market suddenly awake. So, but I think for the high side, yeah, market had did really well, about 10% year to date. I think forward we are, I think the visibility quite high for our market to go higher in second half or even next year. I think for a few reasons. Um, Maybe we can say our politics is really stable compared to a few years back. And one of the reason I think our market outperformed in ASEAN this year because Malaysian market has the highest technology content. I mean, has more technology stocks compared to other ASEAN countries like Thailand, Indonesia, Philippines, Singapore. We have a lot of very good semiconductor companies, and there are more coming. There are good semiconductor are coming into the market. So the third one I think is maybe the robust activities from north and south. South of course is a lot of data center, the RTS going in Singapore story. And from the north side is the LRT. We have a new Silicon Island. This for semiconductor manufacturing. Penang side also a lot of developments because recently I went to Penang. So the visibility for Penang side is quite high because you can see cooperation between private developers and public government. They are putting a lot of effort and budget in Penang because the overall government direction is to elevate Malaysia's semiconductor value chain. So you can look at Malaysian government spend a lot of time, spend a lot of money to grow Penang. So north side also another region target by government also because it's close to Singapore and they think a lot of developments can be done in Johor. So the connectivity also improving, as I mentioned, RTS and maybe more upcoming projects, Singapore, KL, high-speed train, more and more. So, and beside that, I think the government financial is getting more disciplined because they have spent so much money in COVID time and political uncertain. So government coffers also getting weaker. But you're looking at they are cutting subsidy, they are put the money in the right place. So overall, I think in the next three years, government financial will be stronger. And the last but not least is the good relationship between US and China. I think it's one of the beneficiary of the trade war. So we start to see a lot of things coming into Malaysia. You look at FDI number, I think it's a record high, right? Compared to past 10 years. Yeah, this might take Malaysia is the growth outlook is getting stronger.
Okay, thank you, Hao. So adding to what Amiruddin said earlier, like on earnings valuation as well as the economic fundamentals, the political environment in Malaysia has started to get better, and the government is working very hard to attract FDIs and to improve our fiscal balances moving forward. And adding to that, the semiconductor ecosystem in Malaysia is very vibrant, and that has also drawn a lot of attention from the investors as well. And adding to that, the liquidity as well, the market activity has been very vibrant, supported by local institute buying. Since we are talking on investments, perhaps maybe we can go with Encik Amiruddin. Well, like what kind of products that Muamalah Invest offers that could help investors to navigate along this could be volatile time, but of course it also come with a lot of opportunity in the market. So what are the products offered by Muamalah Invest that could help investors in navigating the market?
Okay, for time, okay, we actually very new in the retail market. For time, we only have one product. There's a Malaysian Malaysian equity domestic product, what called Muamalat Invest Islamic Equity Fund that invest in Malaysian market. But for institutional investor, we quite a number of products. When we see the market, we see of course, for retail, we continue to ask them to invest in our product. Then in the future, we are going to launch quite a number of products, including the one that has exposure into overseas market. And we also have product that related to SME industry. It means you can invest in SME industry in a in a low risk way. So that's product we looking to launch. For we have quite a number of corporate client. For corporate client, we ask them to loading up on bond. Basically, Suku, I think it's right time to buy Suku. As we all pointed, even though the people are betting there's no rate cut, but there's no argument that there's no more rate hike, right? You look at interest rate globally in US and Europe, interest rate is at multi-year high. US interest rate is at 5.5%, is the highest since I think is year 2000. I don't know about Europe. Europe at current level, current still very much on the high side. So basically, there's that when you invest in bond, basically you only got in coupon, right? Unless interest rate go up, you can got a lot of capital appreciation. That's why I think for us, it's all asset class now. It's very much we can buy lah, just can load up. So basically, Asian market still cheap, global market still a lot of certain AI will provide a new growth avenue, and even the bond interest rate on high side is a good entry point. I think all asset class is undervalued. Whatever product we have today or we launch, which is a good buy. You know that the only asset class you see that already trading new at on high side is only gold, right? The rest are basically is very cheap. So I think that's why I think whatever product we have, you just can buy. You can safely get return. It just matter whether which asset class get more lah, basically.
All right, thank you, Amiruddin. So look forward to having more and more product launches, innovative product offerings to retail investors. How would you like to talk about our managed account? How you're muted?
Oh, sorry. I think in PCM, we have a number of managed account products. We have PMA, we have PMA 4, we have a 4% mandate, we have a 8% mandate. So as depends on the risk appetite, of course. If you are a high risk investor, you can put in our high risk products. So I think overall, still a good time to invest in Malaysian market, and our investment team, basically we have a very long experience in investing in local market, led by our CIO. So I think we have the capability to capture the market opportunities and to ride on the good trend of Malaysian market, like M2H semiconductor, or even power generation. We have a very experienced team. I believe we can, you invest in Philly capital, we can put your money in the right way.
All right, thank you, Hao. So before we end the session, probably Amiruddin, can you give us one word, or if you can, 2 or even 3 words that describe how you think the market will perform for the rest of 2024?
Okay, basically you see globally market already start a correction. Malaysian market over the past 2 years being more nasty than before, but there's only 3 words to start. Just buy on deep. That's all. I think market will this correction just temporary. Buy on deep.
All right, thank you. And Hao, any last word from you?
Yeah, I think maybe have slightly more words than Amiruddin. Buy and stay invested. Stay invested is very important. If you want to time the market, and better is the time in the market. Yeah, that's all from me.
Okay, I think we are good to wrap up the session. Thank you so much to Encik Amiruddin from Muamalat Invest and Mr. Hao from Phillip Capital Management. Thanks for your time to be our speaker for today. And we also like to thank to all the audiences on Facebook Live for your continuous support. that's all for today. Thank you for dialing in. This update is brought to you by Fleet Capital, your partner in finance. Stay tuned for our next Philip Roundtable. Thank you.
Okay.
Thank you.